Good morning and welcome to the Daily Hunt for Multibaggers, your weekend market commentary. Today is Saturday, March 14th, 2026, and we're diving deep into the AI-generated insights from yesterday's market activity, Friday, March 13th.
Well, we certainly saw a lot of buzz yesterday, Ethan. Our systems flagged numerous user discussions across social media, touching on quite a few different stocks. The overall market sentiment, it feels a bit split. There's a cautious undercurrent due to global uncertainties, but also some intense pockets of speculative activity.
All right, let's kick things off with Apple, AAPL. It saw a significant number of social media discussions yesterday. Some users were talking about substantial losses from buying call options, with the stock experiencing a persistent decline. However, our data shows insider trades with net purchases over the last 6 months. That's a moderately bullish signal, hinting at long-term confidence from those in the know, despite the recent dips. Plus, there's even some speculative talk linking Apple to NVIDIA AI optics and smart glasses. That's a potential future innovation spark.
Ethan, while insider confidence can be reassuring long-term, the immediate picture for AAPL is, pretty grim according to the metrics. The sentiment score is a strongly bearish -7, and users are consistently pointing to global crisis and straight blockade as major headwinds. The current price is about 13% below its 52-week high, which aligns with that slow burn downward trend users are feeling. Plus, a PE of 31.66 is a premium valuation, and with news of App Store fee cuts in China, that could put pressure on revenue and profit margins. We're also looking at a debt-to-equity ratio over 100%. While it's Apple, that could be perceived as higher financial risk in a volatile market. Their previous ratings for much of early 2026 were stay away, and frankly, I don't see anything here to warrant an upgrade.
I hear you, Brooke, but every stock has its cycles. A 13% dip from the high could be seen as a potential value entry for long-term holders if those global crises abate and the smart glasses tech pans out. It's all about looking beyond the immediate noise,
For now, Ethan, the data on immediate market conditions and the potential headwinds to key revenue streams suggests we should approach this with extreme caution. Final verdict for AAPL, stay away.
Next up, NVIDIA, NVDA. There was a post about pre-GTC NVDA calls, and while one comment mentioned it might tank after 100%, that 100% gain part, really gets people excited. NVDA's revenue growth is an incredible 73% too, indicating robust business performance. They're strengthening their AI supply chain and powering AI R&D for major tech companies. That's a powerful narrative for continued growth, especially with the GTC conference looming. It was a cautious buy just a few days ago, on March 12th.
Ethan, that 100% gain followed by a tank sounds exactly the kind of volatility we need to be careful with. The PE ratio is a high 36.78, meaning a lot of future growth is already priced in. If GTC or subsequent earnings don't meet sky-high expectations, that stock could indeed tank. Also, its beta is 2.375, meaning it's significantly more volatile than the overall market. While the revenue growth is impressive, the primary user sentiment is bearish, and insiders have been net sellers over the last 6 months. They were rated stay away for much of December and January. I don't see a clear path to upgrade here, especially with policy risks looming for their AI supply chain. But Brooke, the AI revolution is real, and NVDA is at the forefront. Strong revenue growth like that, it's hard to ignore the potential. Potential, yes, but immediate, highly speculative calls around an event with a high PE and volatility, that sounds like a risk management nightmare. Final verdict for NVDA, stay away.
All right, let's talk Microsoft, MSFT. Now, it wasn't the main topic of discussion yesterday, but the one mention indicated MSFT had a brief window of recovery while Apple was plummeting. That shows comparative resilience, Plus, Microsoft is aggressively integrating AI, launching new healthcare chatbots, and Jefferies even reaffirmed a buy rating. Their revenue growth is a solid 16.7%, with an exceptional net profit margin of over 39%. They were a buy on March 2nd. This looks like a strong candidate, Brooke.
Ethan, I agree on the strong fundamentals. Those margins are truly impressive. A 39% net profit margin and 47% operating margin are signs of an incredibly efficient business. And the 16.7% revenue growth, coupled with an outstanding 34% return on equity, shows they're not just growing, but also using shareholder capital effectively. The PE of 24.75 is reasonable for a company of this caliber, and it's trading considerably below its 52-week high, which could be an attractive entry point. However, the news also mentioned a more significant dip than the broader market recently, and some moderately bearish options traders. While I'm normally concerned by insider selling, the negative 0.73% for MSFT is minor for a company this size.
Exactly. That dip could be the opportunity. Their continued leadership in AI, pushing into new sectors like healthcare, is only going to boost those already impressive KPIs.
It certainly has the potential. The AI developments could definitely accelerate revenue growth and further improve those margins, making it a compelling long-term play. Final verdict for MSFT, buy.
Switching gears to Alphabet, GOOG. Similar to MSFT, it was only briefly mentioned as having a brief window of recovery on a tough day. But the news for Google is consistently positive. YouTube is gaining on Disney, they're signing multi-billion-dollar AI leases, and committing vast sums to data centers for AI demand. That speaks to massive long-term growth potential and market dominance. Alphabet was a consistent buy throughout much of last year and into this one, including March 10th.
Ethan, the social media chatter was almost entirely bearish on the broader market, which isn't great for sentiment. However, you're right, the underlying KPIs for Google are incredibly strong. An 18% revenue growth and over 32% net profit margin are robust. Their PE of 27.86, while higher than average, is justifiable given that growth and profitability. The stock has shown a significant upward trend from around $163 to $307 in the last year, which strongly contradicts the general market doom and gloom we're seeing. Their strategic investments in AI are crucial and could certainly boost those KPIs further.
So the social media fear isn't really telling the Google story, is it? It's a powerhouse, well-positioned for the future.
Correct. The news and fundamentals are very strong. The generalized market fear does not seem to align with Google's individual performance or prospects. Final verdict for Google, buy. Last but not least, Micron Technology, MU. This one was really hot on social media, with multiple YOLO posts showing incredible short-term gains around earnings expectations. One user showed an $18,000 gain from a $3,000 options trade, calling MU insane. The news even confirms a major bull run with 177% growth rate ahead of their earnings on March 18th. Plus, insiders have been net buyers of a substantial number of shares, which is a powerful vote of confidence, signaling that those closest to the company believe in its future. Whoa, hold on, Ethan. YOLO and insane are not exactly the words I look for in a stable investment. While that 177% growth and insider buying are impressive, the detailed discussion around their earnings showed significant caution. Users were warning about IV crush and the need for an unrealistic 20% price surge just to break even on short-term options. The stock is currently trading very close to its 52-week high, and that PE of 40.47 is extremely high, pricing in a lot of future growth. Any disappointment in the upcoming earnings could lead to a sharp correction. And let's not forget that extremely high debt-to-equity ratio of 21.244. That's a major red flag for financial risk and long-term stability, despite the current growth. They were rated stay away in mid-January.
But the insider buying, Brooke, that's long-term conviction right there, suggesting they see sustained growth beyond this earnings report. That's a huge positive.
It is a positive long-term signal, but it doesn't erase the short-term risks of a high valuation, massive debt, and the extreme volatility around earnings. For speculative short-term options, it's a definite stay away. But if we consider the long term, and if their earnings are truly spectacular to justify that PE and start addressing some of the debt, then maybe, just maybe, it could be a cautious buy for patient investors willing to ride out the volatility and a potential post-earnings dip. Final verdict for MU, cautious buy. Investigate as buy, Microsoft Corporation, Alphabet Inc. Investigate as cautious buy, Micron Technology Inc. Investigate as speculative gamble, NVIDIA Corporation.
And that wraps up our daily hunt for today.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in. We'll be back next time on the Daily Hunt for Multibaggers.
Have a great weekend, everyone.